Welcome back to the channel. As always, if you copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a company called Dutch Bros Inc., ticker BROS. And what these guys do, they're essentially a coffee chain, which, as you can see here in the chart, went public just a few years ago and has had a bit of a surge in terms of stock price since late 2024. And why is that? Well, if we can talk about what they do, they have been really good in terms of perfecting the drive-through for coffee delivery, excuse me, coffee service. So unlike the 5-minute wait at Starbucks, these guys are delivering coffee in under 3 minutes. And this speed has been critical to enable the rise uh, of this company in terms of speed. So this company can serve about 20 cars per hour versus Starbucks that serves between 12 and 15. That is a 40% capacity advantage, translating directly to revenue. But where it gets interesting is actually restaurant traffic nationwide is down 2%. So at the same time, these guys are reporting transaction growth of nearly 4%. So that means that they're not just maintaining share, they're actually stealing customers from different locations and competitors from some of their competitors, right? So we're talking about Starbucks, Dunkin' Donuts, and other independent coffee shops across the country. At the moment, they have 1,043 locations with a target of get to 7,000 eventually, but we'll come back to this in a second. Why it's important as well is not only how many shops they have, but also how they are running the ones that they have built so far. And the digital channel is something that they have been able to catch on very quickly. So 2 years ago, 67% of their customers were in their rewards program, which is pretty good. But that has now changed to about 72%. And that whilst that doesn't sound as a massive difference, it's only 5% percentage point. The rewards member visit 2.5 times more frequently than non-members. So that's 2.5 million additional high frequency customers generating an extra 125 million in annual revenue from that change alone. So if we take 1 second here to take a look at the financials, right? You can see that that number at their current total revenue of 1,452 million is pretty significant, actually. We're talking about just under 10% of sales just from that change. And if we take a closer look at the financial performance of the company, yes, we can see that there has been a little bit of revenue growth slowing down, but it's still very impressive how they've gone from 327 million revenue in 2020 to almost 1.5 billion over the last 12 months. That is phenomenal growth by all standards. And yes, whilst margins have also shrunk a little bit, they do remain very healthy. But what is important is that actually EBITDA margin is actually growing. And that is really what is important to us. Same thing happening with net income margin. So the financials look very, very healthy. Debt has remained within reasonable levels, and the cash from operations remains very healthy, and again is a massive jump at 272 million compared to just 5 years ago at 50. So that is very, very good numbers across all areas. So the real breakthrough, right, came with mobile ordering. That was one of the game changers for them. So that stands now at only 11.5% of transactions. But in new markets like Indiana, where they are expanding, is running at 23. And the reason why I mention that is because some of these markets that they are entering now have actually proved to be some of the fastest growing for them. So it's not only capturing new market share, it's also about how quick those new markets are catching on in terms of revenue generation. And mobile orders cluster in the morning rush, exactly when drive-thrus typically hit capacity constraints. So by routing these orders to their walk-up window, they've essentially added a third lane without building anything. So there's a lot of efficiencies going on here. The morning opportunity represents their biggest untapped market. They capture only 25% of their sales in the morning versus 35% in the afternoon and the evening. And that's the opposite of typical coffee chains. And the reason for that is because they lacked food options for the breakfast crowd, but now that is changing. At the moment, 64% of the stores offer a limited 8-item breakfast menu. And the early results show that both ticket increases about $2 per order, but also they are capturing new morning customers. So they can just shift 5% more sales to morning hours. That's a 200 million opportunity. Again, put that on top of the 125 that we mentioned before, it becomes 325. Very significant for a company that's making $1.5 billion. And in terms of how this food test is going, management said in the previous earnings call that results are exceeding their expectations. So where does this leave us now? Well, in early October, they will announce Q3 store openings. They promise 40 new stores. That's a 30% jump from the recent 30 store quarterly pace. But like I mentioned before, newer markets are outperforming actually twice as fast compared to the old markets. And they have 450 trained operators waiting to open these new locations. If they announce uh, results in line with their expectations, or even better, to beat those expectations, it signals that they can accelerate to a greater number by the next coming years, possibly by 2027. And that is important because it works toward their milestone to have 2029 stores by that year, 2029. So you can see quickly how this milestone could really get that narrative going in terms of building credibility in the market and building those high expectations for the company to not only maintain but actually accelerate that growth momentum. Of course, we mentioned that the food expansion announcement could also add further traction to that. So each food attachment drives a few dollars in incremental beverage sales. That becomes really large when you expand that throughout the whole company. And then in November, we have additional catalysts. So we have the holiday season, right? Their Q2 beat was driven by limited time drinks and merchandise that sold out in days. Um, and we also have a few other things in the calendar. We have, of course, earnings coming on the 7th of November. So we should see then news from management in terms of any of the items that may want to show to the operations, and of course, new estimates for the year, which at the moment are looking pretty healthy. You can see how they increase EPS recently. And yet, for some reason, and this is one of the reasons why I think is a good time to enter, the stock has remained with a significant target to price target difference that is quite high. So this creates a bit of a dislocation in terms of price as an opportunity for us to get in and capture that upside. In terms of risks, of course, the valuation at the moment is significant at 75 times next 12-month earnings. So if something over the next weeks goes wrong in terms of announcements, execution risk is there, yes, we could see this setup that we have here with these lines, right? It's a bit of a pattern that is going to break somewhere. We could see that going down. But at the same time, the fundamentals are pretty strong and signal that we could see the stock going to 75 or even 80 by December. And that's the way I'm going to be structuring this trade. I'll be buying the $60 December calls, which are selling at 650, and selling the 65 November calls at 350. That provides a pretty good return. If the stock gets to, say, 75, it's a pretty good trade um, before the 21st of November. And it can make 3x if we get to that level after the November expiration. So pretty good odds for me. I'll leave it there. Thank you for watching the video. See you soon.